Welcome to Get Rich with Rich. I'm Rich, founder of Under the Radar Report. Well, the animal spirits have been unleashed. That's right, we've had a couple of takeover bids. One for Quickstep, QHL's the code, carbon fiber parts manufacturer of F-35 jets. Subscribers might be aware of, bought by private equity interests, which involve one of its big customers. The other, Silk Logistics, basically the third biggest logistics firm in Australia. And you probably wouldn't have heard of it, but for Under the Radar Report. So that's been the offer there is probably more certain to go through by one of the biggest logistics operators in the world to buy base DP World. So exciting stuff. Today, I want to talk about how banks can help you unleash those animal spirits in your portfolio. That's right. You heard me right. So the brokers have been wrong on the banks. Why have they been wrong? They've been saying sell or variations of sell for at least a year now on a lot of the banks. And why are they so negative? Well, two words: multiple expansion. Basically, Westpac has returned close to 60% in the past 12 months. And yet, despite this, its earnings are forecast to be flat. So the PE, the price earnings multiple on Westpac has gone from 10 times a year ago to 16.5 times today. And we've seen similar multiple expansions across the board on the big banks. Like CBA is trading at 26 times. Like that's forecast earnings. Another factor in the big banks is that profitability is actually going the wrong way. Return on equity has gone from like 18%. So these banks were just phenomenal profit machines, 18% like at the start of the century. Now it's like between 10 and 12%. CBA might be 13%, Westpac ANZ might be 10%. So we've seen more competition eroding profits. Now I want to get to where the brokers are missing a trick. Basically, a PE is governed by two things. One, expected earnings growth. Two, variability of earnings growth, so volatility. So basically, what's happened with the banks is they had a lot more volatility in earnings growth when their asset bases were broader and they had more varying different business models. They're in wealth, they're in this, they're in that. Now they've turned themselves into utilities with the helping hand of our old friends at APRA. Certainly, the 2018 Banking Royal Commission also helped accelerate that process. But the point is that these banks are now dividend producing machines. And, you can see that in the yields, and they've actually increased the payout ratios. The average yield is around 4.5%. So CBA might be 3%, ANZ might be 5.5%. So instead of going for growth, the banks are using their various portfolios to make strategic bets. So they're being far more circumspect. They're not just going out there and embracing and taking on risk. So CBA and Westpac, for example, have moved into business banking. When it got really hot in the mortgage market. All the banks are doing this to varying degrees, shuffling their energies, their assets around to suit where they think they can get the best returns. A very sensible strategy, but not one where they're going for broke to get growth. So the brokers are also missing where the real value of the banks is. And that's the embedded value of these huge income streams they get from their mortgage books. They also get from their deposit bases. So ANZ intimated this, in its most recent result when it talked about the benefits of a Suncorp merger. Look, what do? Simply bank those dividends and go out. Bank them on lifestyle. Make hay while the sun shines, go and have a good time, or go for growth. Bank those dividends and invest in growth. So of the banks, the one that we like the most is Macquarie Bank. Why? Because it has the greatest growth potential. Why is that? Because it's got all these latent assets that can be unlocked when the IPO market starts moving into action. And right now it gets back to that, animal spirits. We're seeing evidence that there's going to be more deals. Think in Macquarie's case of how much it made in AirTrunk. It sold AirTrunk for $24 billion this year. Well, there's going to be lots more AirTrunks for Macquarie. So when the animal spirits are running, your best bet is growth. The best value is in small caps. That's where you can get growth for value prices. That's what we're looking for. That's what we look for. So read our best buys today. So what's coming up? I promised new small cap stocks. That's what we're bringing subscribers. They're coming your way. We're also updating dividend portfolio and more. Great to see you again. See you soon on Get Rich with Rich.